Hi, I'm Gerdie. I work as a financial risk management consultant here at Deloitte. I have a main focus on credit risk modeling, but also credit risk model validation. In this Voices from the Field session, I will talk about the changing regulatory landscape for credit risk. So let's take a look at the changing regulatory landscape for credit risk. First, I will explain why this regulatory landscape is changing and what is the impact on credit risk models. And second, I will talk about the regulatory calendar and what can banks expect in the coming years. So let's first take a step back. This slide shows an overview of some of the regulatory changes in the Basel framework. The purpose of these regulatory changes is to be able to better compare risk-weighted assets between banks. Currently, there is a lot of variability between risk-weighted assets across banks. And this makes it very difficult for supervisors, but also for example, investors to compare banks. So if we first look at Pillar 1. Pillar 1 basically covers the capital requirement calculations for credit risk, for market risk and for operational risk. Currently the Basel Committee puts restrictions on the use of internal models for each of these three risk types. For operational risk, we see that the internal model approach is already removed from the Basel framework. And for credit risk and market risk, we see that the Basel Committee puts restrictions on the use of internal models and also make the models more predefined, such that there is less freedom for banks to actually design these internal models. So Pillar 2, we see that supervisors are looking not only at the Pillar 1 capital requirement calculations, but also at, for example, business models of banks and at banks' internal governance. Additionally, in Pillar 2, also additional risk types are covered. For example, interest rate risk in the banking book is such a risk type that is not covered in the Pillar 1 framework. And the supervisors are also looking into interest rate risk in the banking book in much more detail than they did before. And then Pillar 3, we have the disclosure requirements. Currently, banks have to disclose a lot more than they had to do before. But this should also make banks more comparable across each other, because investors can actually compare much more details of the bank than they could before. So to summarize, the Basel Committee wants to increase comparability of risk-weighted assets across banks. First, they put more restrictions on the use of internal models. Second, they aim for a more consistent supervisory approach. And third, they want to increase transparency by introducing extra disclosure requirements. So next we're going to have a look at an example of variability in risk-weighted assets. So this graph shows the risk weights for defaulted residential mortgages under the IRB approach. So at the left-hand side, we see risk weights of even above 300%, whereas at the right-hand side, we see risk weights of 0. So there is a very big difference. And this difference is caused by many things, but part of the differences are caused by differences in internal models. So for example, different default definitions are used, PD and LGD are modeled in a different way, and there's also differences in the treatment of defaulted assets. Let's now zoom into the regulatory landscape for credit risk. So this slide shows an overview of the main components of the changing regulatory landscape for credit risk. So if we first start at the top, the future of IRB. The future of IRB is actually initiated by the EBA. And EBA wants to have a more consistent and more harmonized IRB framework. They do this by publishing guidelines and technical standards on different components of internal models. and banks have to actually comply with these standards. Then there is the revised IRB approach, which is something Basel came up, which is actually puts more restrictions on the use of internal models. So for example, Basel actually does not allow the internal model approach for certain portfolios anymore. Basel also came up with a whole new standardized approach, which is the revised standardized approach. And in relation to that, they started a discussion on capital floors, which means that there is currently a discussion going on putting a floor on the capital requirement calculations. For example, a floor using a certain percentage of the standardized approach. So banks are very busy with developing and adjusting their internal models, but also with introducing the standardized approach. So that's on the capital requirement calculation side. Then there is also IFRS 9. IFRS 9 is a new accounting standard which requires much more advanced modeling techniques for the use of provisioning calculations. So actually banks are currently very busy with developing these more advanced models as well. Well, a last item is the targeted review of internal models, also called the TRIM. This means that the ECB is going to perform a very extensive review on the internal models of banks, which also requires a lot of extra work for banks. So to summarize, there are a lot of regulatory changes within credit risk. So there are the IRB models, which need to be updated and redeveloped. Then there's IFRS 9, which keeps banks very busy. And then the ECB is going to perform a very extensive review on those internal models. So let's now zoom into the future of IRB. So as I mentioned, the future of IRB is initiated by the EBA. And the purpose of this future of IRB is to have a more consistent IRB framework. So the EBA already published the RTS, so this RTS on the assessment methodology of the IRB. This is actually a kind of a handbook for the regulator in assessing IRB models of banks. It's very extensive and it includes, for example, guidance on the definition of default, quantification of PD, LGD and EID, but also information on internal governance, data and IT, or the design of the rating system. Another very important guideline that recently has been published is the guideline on the definition of default. The purpose of this guidance is to have a more consistent definition of default across banks, which also should lead to more consistent model outcomes. So this guideline includes information on different topics on the definition of default, for example, counting of days, materiality threshold, and unlikely to pay triggers. But there's more to come. So more guidelines are, for example, expected on PD estimation, LGD estimation, downturn calibration, or treatment of defaulted assets. Then by the end of 2017, more guidance from EBA is expected on, for example, credit risk mitigation and liquid assets. So banks are currently very busy with adjusting their internal models to make them compliant with regulation. So there are a lot of regulatory developments within the future of IRB. But this is not the only development we observe. We also see the drivers for credit risk models change over time. In the past, credit risk models were designed to support business, for example, on their loan application process. Well, currently banks are very busy with becoming regulatory compliant and adjusting their models to meet those regulations. But we also see different developments. For example, client expectations are currently changing. We now see that clients want to have immediately know whether they can have a loan or not by, for example, having an online loan application process. So this is also something banks are started to work on, and actually innovation and all kinds of technological developments make it really interesting to look into more business-driven credit risk models. As I mentioned, an example can be instant credit assessment, where a client can, for example, online apply for a loan and then immediately know whether he can get the loan or not. And this requires an instant credit scoring model. Another interesting topic is continuous monitoring. What we currently see is that banks review their models, say, quarterly. But actually, as a bank, you want to have, at every moment in time, you want to see how risky your client is, which can also prevent defaults. So we see banks are currently experimenting with more advanced data analytics to be able to have, for example, instant credit assessment and continuous monitoring. So I hope you enjoyed this Voices from the Field session. There are a lot of regulatory changes affecting credit risk models, but there's also a changing customer expectation, and we see much more advanced data analytics used in credit risk models. And I think this is a very interesting time to work in credit risk modeling.